everyone, and welcome to this wealthmanagement.com Fast Chat. I'm David Armstrong, the editor of wealthmanagement.com. And today I'm speaking with Peter Higgins, the head of fixed income investing and the senior portfolio manager at Shelton Capital Management. Peter, thanks for joining us again.
Thanks for having me back, David. Pleasure to be here.
So a lot's happened since the last time we spoke. I think back in March, middle of March, including we had a 25 basis point increase from the Fed. You want to just give us a quick summary of your thoughts on what's happened recently since the past couple months?
Sure. It's kind of timely when we have our conversations. I think the last one was literally in between the early days of the regional banking crisis, but before that March FOMC rate decision. And if you look at returns since then, you'd think nothing happened. The ag, which is a good benchmark proxy for the fixed income market, is up over 0.5%. You've got high yield bonds that are up over 2%. And the Nasdaq's even up 10% since the last time we spoke. But it hasn't exactly been a straight line. It hasn't been smooth sailing. There's been a lot of volatility and really air pockets effectively at a sectorial level or across different asset classes themselves. But you're right. At the time we spoke, we did suggest that there would be another 25 basis point hike. That did indeed come. We also spoke a little bit, I guess, foreshadowing the events to come. And we said that it wasn't our real belief that the banking crisis would be systemic. And that's important. However, we did see Silicon Valley Bank go down, led to Signature Bank, one even across the pond to my old firm, Credit Suisse, that was succumbed to UBS. And then it came back to the West Coast with First Republic and PacWest, and things are still percolating out there. I guess the point that I'd make on the banking crisis right now is that we feel confident at Shelton that regulators have reduced that risk of being systemic. They will act, they will provide liquidity if and when the time is necessary. But what hasn't changed since we last spoke is uncertainty. There's a lot of it out there.
Yeah, that was going to be my next question. We did end that last conversation on the note of uncertainty. And it sounds like you have more clarity now or no more clarity now?
There's some trend lines coming. Definitely not full clarity, but the trend lines are as follows. You've got employment starting to slowly roll over. And we've had a couple data points since our last conversation. We've had a few more data points on inflation, which is trending downwards, albeit probably a touch too high for the Fed's liking. And you've got a consensus building in the marketplace that the Fed will pause at its next June meeting. This morning, that probability was about 75% market participants expected it to pause. However, last week it was about 90%. So there's still some in the decision out there, but we'll see what June brings. I guess the point is, though, uncertainty still exists. And since we last spoke, there's been a couple new events that have added to further uncertainty.
Okay. Well, you want to tell us what those new events are and what's kind of making the outlook a little cloudier for you? Sure.
I mean, the obvious one that is capturing all the headlines today is the debt ceiling. I'm not going to profess to be an expert on this, but it's a known unknown. And if you look at it in the context of history, it causes volatility across all asset classes. So the closer we get to the X date, which Treasury Secretary Janet Yellen has declared to be in early June, the more volatile all asset classes will become. And we're already seeing a spike in U.S. Treasury bills that mature right around that X date. The other new event hits the credit markets a little bit more. It's the release early last week of the Senior Loan Officer Opinion Survey, which I will call the SLOS. This basically is a real good indicator for credit spreads and defaults in our market. Effectively, it collates the amount of banks tightening their lending standards across the United States in a variety of categories. The net result is that 46% of banks are tightening their credit lending standards. That's up from the last quarter, which was about 44.8, but it's still down significantly from the global financial crisis, as you would hope to expect, where it was above 80%. So the bottom line is, yeah, banks are still growing. They are lending more credit, but it's contracting. And once you breach that 50% threshold, you'll be in decline again. But what was interesting was the decline in demand. This is recorded the second highest, or I should say lowest print of all time for demand for loans. And I guess that makes sense, right? I mean, if 2 years ago you would have wanted to go buy a car and get financing at 1, 2, 3%. Today that's 7, 8, 9%. So you might put that purchase on hold. You might not want the demand for that loan. And you're seeing that percolate through the economy right now.
So for investors, last time we spoke, you were talking about how bond prices basically are a reflection of both technical and fundamental qualities. Can you talk a little bit about how you're seeing the uncertainty that you just spoke about impacting those fundamentals and technicals? Give us some examples of how they're impacting the markets today.
Yeah, why don't I just carry on with the commentary on the slows survey. Basically, tighter lending conditions mean less credit is accessible for growth. Slower growth could end up in a recession. So from a macro fundamental standpoint, you might see the Fed cut rates. And in fact, that's what the market is pricing in, despite the Fed still being strong and towing the party line of not cutting rates throughout the remainder of 2023. From a micro standpoint, slower growth makes it more challenging for lower rated credits with greater debt loads to grow into their capital structures. So it has an effect on the fundamental side. An example of technicals, I guess, can be defined simply as the balance between supply and demand. So maybe I'll use the high yield market as a good example. On the supply side, new issues or primary bonds priced year to date are up minimally year over year. You have outflows, but those outflows have more than made up by the coupon payment. So you've got net cash coming into the market. And then the biggest technical going on in high yield right now is the amount of rising stars, those high yield rated companies that are now investment grade rated. So what happens in our market is, especially those dedicated high yield funds, once those holdings migrate up to investment grade, they sell them, use those cash proceeds, and recirculate that into other high yield bonds, propping up market prices. So you've got this scenario where there's more demand than there is supply, which is a great example of technicals, and probably one of the main reasons why spreads are kind of flirting with historical averages today, despite the economic gloom that is around the corner. Another example of, and this is, I guess, a timely example of technicals is that, the FDIC inherited a portfolio of bonds from the bankrupt regional banks. And they've, on the municipal bond side, they've started selling some of those to the market. They went well, but there's a lot more supply behind that. So you could see a scenario where there's more supply than there is demand, which hurts prices. And I think what we're seeing right now in the muni market is it's sort of in limbo. It's in a holding pattern, waiting for the supply to be met with the right amount of demand before the market makes its final decision of whether to move up or down.
So given the economic conditions that you just laid out and some of those specific examples, how are you changing your portfolio? If you are, how is it impacting how you're allocating money?
You know what, we do make portfolio construction for the short and medium term. And since we last spoke, we haven't changed it too much, but there are some subtle changes, and I'll get into them. I guess on the macro side, again, if growth is slowing, mainly, then there could be a recession. If there's a recession, the Fed could cut rates. And when the Fed cuts rates, investors would want a duration. That measures the interest rate sensitivity of a bond. The longer the maturity, the greater that sensitivity is. So we, in our portfolios, have gone out a bit in duration to take advantage of this potential pause of the Fed hiking and potentially the end of that hiking cycle. And then on the micro fundamental level, there's going to be more credit dispersion. And we're seeing that in the market where company reports good earnings, bond prices do well. If it reports bad earnings, bond prices are met with a lot of sellers and those levels go lower and lower and lower. So there's kind of the haves and the have-nots, probably seeing a lot of the similar functions in the equity market as well. So from our perspective, nothing's changed, but we do have to be more acutely sensitive to remaining vigilant on the credit underwriting process for the names that we populate our portfolio with.
Makes
and then
sense.
I guess on the technical side, I mentioned that the high yield market is shrinking because of all these rising stars. So former double B rated high yield issuers are now investment grade. So the last time we spoke, I think I mentioned that we were straddling the investment grade / high yield cusp, mainly in lower triple Bs and higher double Bs. Well, I think the technical backdrop that I had already mentioned supports, those types of holdings, especially in double Bs, where those other fund managers may sell their high yield holdings and repopulate it with new double B holdings, supporting prices. So, we've extended duration. We've kept the quality higher, in part because of technicals, but mainly because of the fundamentals, where we do think a recession is on the horizon. Rates will get cut, and fixed income will be the beneficiary of duration in the portfolio.
That's interesting, because we hear from some financial advisors that they're thinking about further fixed income positions, using U.S. Treasuries as an alternative to the broader fixed income market. It seems to make sense with interest rates higher. What recommendations would you have for those advisors who see Treasuries as an alternative to fixed income products?
You're very astute. We're hearing the same thing from our clients. In fact, quite often. What I would say about T-bills, they're short-term instruments. Your return is the interest income generated. But if you buy a longer dated bond, whether it's a treasury bond or a corporate bond, your total return is going to be captured not just by the interest income, but by any potential capital price appreciation. So if you run a scenario, and I've done this mentally because we've been asked so often, if you take a 1-year time horizon and buy a 6-month treasury bill today at roughly 5.11%, and then the yield curve drops 25 basis points, and you buy another 6-month treasury bill in 6 months' time, then your all-in return is about 4.8%. But if you were to buy a generic double B high yield bond, I'll use Warner Music Group as an example because many of your listeners may have heard of that company. It's rated double B. It's 3% bond due in 2031, trades at a steep discount. But if you put the same amount of capital to work by buying that bond and holding it for 1 year and seeing the interest rate curve drop 25 basis points, the power duration is going to impact your returns to the point where you make 7.6%. So you're almost 300 basis points better than owning those T-bills, because keep in mind, T-bill might look attractive today, but if that interest rate curve changes and you want to buy more T-bills, you're getting a lower coupon tomorrow. It's a great example of, fixed income. When interest rates and yields go down, prices go up. And, our belief is that you will see the Fed cut if and when this recession occurs. And those asset classes with duration will be the beneficiary of total return.
Makes sense. So don't chase the shiny object. Peter Higgins, this has been great. Thanks very much for joining us. Peter Higgins, Head of Fixed Income Portfolio Manager at Shelton Capital Management. And this has been a wealthmanagement.com Fast Chat. Thanks for listening.
Appreciate it, David. We'll see you later. Bye-bye.